We're on the eve of destruction. Not. Could dividends be better than expected? And Rickard's terrific tax tips. I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money. All right, Paul, I hope you looked engaged.
Well, I did. At least I got my contribution, the introduction, Peter, was okay.
Okay, right, so yeah, it's good. Because people have commented that, apart from the fact that people have observed that you're a lot better than what people expected in terms of your contribution and your knowledge, all those sort of things have shocked people. Some people have noticed you look like a stung mullet while I'm doing the introduction. I hope
Next.
Okay, the first topic, eve of destruction, not. I wrote a piece today thinking, looking at this economy, it looks like we're on the eve of reconstruction.
We're certainly getting some better data, Peter. Yesterday, the numbers of both jobs. There's also some good data from CBA about retail sales in terms of people using FPOS machines.
Yeah, okay.
Look, maybe giving a little more credence to the so-called V-shaped recovery, and I guess that's what we're seeing in the US as well with their retail sales data.
Big number, wasn't it, Paul?
Well, yeah, up 17%, but only followed, I think, about a 14% fall the month before. So that's sort of 14 down, 17 out, it's almost the same, right?
But the economists only thought 7%. This is the thing that's really surprising me, Paul, or making me feel happy. A lot of the economists' predictions are a lot worse than the reality is showing. So we saw with the job numbers a couple of weeks ago, they thought they'd lose 8.5 million jobs, and they got 2 million. So all the economies seem to be improving better than what the economists are predicting.
Well, you were surprised that economists have got it wrong yet again. Now, look, they are, and I guess that
non-economists,
not an economist gives a little more credence.
Yeah.
I still think it's going to be tougher than people think, and the markets are ahead of themselves.
Yeah.
But you can see why the market is back to where it is.
Yeah.
And now, again, in Australia, we're sort of back towards the 6,000 level. The US, look, I still think there's some uncertainties out there, so I think the market, my guess over the next few weeks will come back a bit, but we've got over the initial sort of
But what
shock.
about $1 trillion US?
Well, you can't, the old
Trump?
rule, don't fight the Fed, and if the Fed wants to keep buying bonds, buying corporate bonds...
And Donald wants $1 trillion worth of infrastructure?
And Donald wants to do infrastructure, don't stand in the way of it. So it's not a market, with the long-term trend of up is still in place. The question is whether it got ahead of itself a bit.
And one last thing before we go to our next little topic is, as Jerome Powell said last week, the Fed boss, he said, they've never seen a government policy and central bank policy so big and so fast. And that's what's actually helping this market, because we calculated how bad it would be, but it's hard to calculate how good it can be when you throw all this stimulus. Let's hope the good guys keep on winning. Paul, next topic. Could dividends be better than expected? If the economic scenario is better than expected, could the dividends, say, get into 2021 better than expected?
I think so, Peter, and it goes back to, let's go rewind history a little bit. A couple of months ago, or 3 months ago, everyone was talking about a V-shaped recovery. 6 weeks ago, people had gone off the V-shape, said it's going to be more like a U-shape.
6 months hibernation.
Yeah, 6 months hibernation. Now there's more talking about the V-shape. So maybe we're going to get somewhere between a V and a U. I'm not sure what...
A view, we'd call that, a view.
You could trademark that one. Anyhow, look...
Stole it from Chris Joy.
If we get somewhere between that, Peter, obviously that's going to be better for company earnings. It means companies are going to have to be less cautious on their balance sheets.
Yeah.
And that's putting the likelihood of dividends going back up a notch being high again.
So bad August, September, but could be better in February.
Well, we could even see a couple of surprises come the August reporting season. But let's just see how it goes.
Yeah.
One thing we are now into, but yet we haven't seen too much damage, is confession season. As we get into the first couple of weeks of July.
Explain what confession season is,
look,
Paul.
companies have an obligation under the ASX rules to keep the market up to date and informed. So if companies need to look at, as soon as they become aware that their performance is less than what the market is potentially anticipating or the analysts are saying,
fess up.
They have to fess up. So they can't wait till, when their normal reporting period of August, when they get the final numbers and the auditors have dotted the I's and crossed the T's. If in early July they've just looked at their June numbers,
There's a crap.
and then it doesn't look very good, and they know what it's been for the last 6 months. They can add the last 6 months, notwithstanding what the auditors need to do. They need to fess up and start to warn the market. So we're about to get into confession season. It's we haven't seen anything yet, but that'll give us the shape of what's to come in August. So coming back to your question, could dividends be a little bit higher? Well, certainly if the numbers are coming through better, companies will be more encouraged to look after their shareholders.
Pray for a good economy, ladies and gentlemen. Finally, Paul, your terrific tax tips. June 30 looming.
Well, we're only 12 sleeps away, Peter. Who is counting? Are you counting?
You are. I haven't, but now I know. We go.
Look,
All right.
I think the number one tip this year is, of course, for anyone who had to stay at home, there's a special shortcut version for working out stay-at-home expenses. Essentially, the ATO has said, look, it's all too hard for everyone to go and work it out themselves. We'll give you a per hourly rate, and all you need to do is keep a log of how many hours you worked at home from the 1st of March through to the 30th of June. And you can claim an 80 cents per hour deduction, no receipts, no documentation. You just need a logbook that says, I worked so many hours at home. So for example, if over that period from the 1st of March to the 30th of June, you worked 40 hours a week, you stayed at home for the same period, you can claim effectively $32 a week. There are 16 weeks. It's something like about a $540 deduction, no questions asked. It's called the shortcut method. It's a one-off, only relates to COVID-19 work at home, and applies from the period from 1st of March through to the 30th of June.
Do you think someone who's been working 24 hours a day for 8 weeks at home could be investigated, Paul?
I think 24 hours a week, 8 weeks, it could be a bit much, but look, it's going to have to be reasonable. But look, so none of this. There are, of course, the traditional methods. You can do all the hard work as normal and look at all the things you spent money on. So there are the usual methods if this doesn't work out to give you the best outcome, but it's just a really easy way. So
that's going to cover heating, electrical.
It covers the whole lot. So you don't need to any other claim. You just have a logbook that said I worked these many hours from home, 80 cents an hour. Put the claim in.
I guess the flip side is you actually do calculate the hours and you make it proportionate. So
the other methods apply if you worked longer or you actually incurred a lot more costs.
Or you use a lot more heating than the average person.
Working from home outside that period. You might have been working home permanently right throughout the year, okay? So there are other methods that you can use. So have a look at that. It's a simple method.
And you'll give another tax tip next week?
Yeah, we're going to have tax tips. Just as I said, the general thing here, of course, general rules, deductions, all those sort of things, general principles. If you can, prepay expenses, defer if you can, up to a point income.
And
so,
a good tax tip would be, say, to buy a Ferrari before the end of the year.
Well, for small business, of course, you've got the $150,000 instant asset write-off, and of course, for investors, don't forget about capital gains tax. So,
we'll do that next week.
You will to talk about capital gains tax. You've got to get your act together pretty soon on that one.
I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money.
Shh.